Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be analyzing if Celsius Holdings stock is a buy. Celsius, stock ticker symbol CELH, is just one of many companies we explore on this channel. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Celsius. Founded in 2004, Celsius has carved a niche in the booming energy beverage market, aiming to become the global leader in scientifically backed, health-conscious drinks. They currently boast a team of roughly 400 employees dedicated to crafting their core product. Celsius packs a punch with a proprietary blend of thermogenic ingredients, clinically proven to accelerate metabolism and burn body fat when combined with exercise. The company sells an assortment of sparkling and non-carbonated energy drinks. Thermogenic energy drinks, stick packets to mix with water, perfect for gym bags and busy schedules, and a new line of functional waters infused with electrolytes and essential vitamins. Now let's look at the price action. Starting with the 1-year chart, we see that Celsius had a CAGR of about 46%. Zooming out to the 5-year chart, we see that Celsius had a CAGR of 112%. Wow. Love that growth. Celsius share price has grown tremendously over the past 5 years. If we perform a backtest comparison of investing $10,000 in Celsius versus the S&P 500, we find some strong results for Celsius. In that comparison with the S&P 500, $10,000 invested in Celsius would have grown to $282,914 or a 76% CAGR versus $18,848 or an 11% CAGR if invested in the S&P 500. This demonstrates ridiculous outperformance for Celsius. However, a Celsius investment would have been a lot more volatile with a 73% standard deviation versus 18% for the S&P 500. Celsius outperformed the S&P 500 in terms of the best year performance, for which Celsius grew an astonishing 942% versus S&P 500 31%, but also doubled the worst year performance where Celsius fell only 34% versus the S&P 500 18% fall. In terms of max drawdown, Celsius fell 51%, more than the max drawdown of 24% for the S&P 500. Nevertheless, Celsius outperformed the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio, indicating that the share price volatility was well worth it. Now let's hop over to market share and take a look at Celsius's market share. So we come over here and type in the ticker symbol for Celsius and see that the market share is very small, just 0.13% out of the publicly traded food, beverage, and restaurant stocks currently in the market. This means that 0.13% spent for food or beverages goes to Celsius. This is a very small market share, but it is growing. The 5-year market share CAGR for Celsius is 91%. This means that Celsius's market share almost doubles every year. If we start in 2019, we see that the market share was 0.01%, 0.02% in 2020, 0.04% in 2021, 0.08% in 2022, and 0.13% over the trailing 12 months. This is the kind of market share growth we want to see. Let's take a look at the fundamentals. Gross margin is 48%. This is slightly lower than other beverage companies. Revenue has compounded at around 91% over the past 5 years and has reached over $1.15 billion most recently. Whoa, that is awesome. Clearly, revenue growth went exponential in 2020 and has not slowed down. Looking at cash flow, we see strong growth over the last 5 years for operating cash flow, while capex has worsened at a 191% CAGR. As a result, free cash flow has grown from -$12 million to $56 million most recently. After a negative free cash flow in 2020, Celsius has returned positive free cash flow, although this has been falling since 2022. Weighted average shares outstanding have grown a lot over the last 5 years, going from 150 million shares in 2018 to 235 million shares most recently. Celsius has been diluting shareholders a lot. 2 recent press releases explain more. In 2019, Celsius sold nearly 7 million shares, with insiders selling about 1 million shares to generate about $25 million. They used the money to fund the acquisition of Func Food Group. Similarly, in 2021, Celsius sold 6.5 million shares, with insiders selling about 1 million shares to generate around $63 million to be used for general operations. In both cases, Celsius gave insiders the opportunity to get some liquidity and raise some funds for the company. From a company operational standpoint, raising cash via equity offering is a nice tool to have in a business toolkit. However, as shareholders, dilution is never good. I get the feeling that management is very willing to dilute shareholders again if the opportunity arises. Now let's view return on invested capital. Return on invested capital has grown from 13.7% in 2020 to 24.7% in 2023. Celsius has become a bit more efficient in driving profits from its investments, with a trend bottoming in 2022. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 122 days in 2018 to 129 days most recently, Celsius has gotten a little less efficient over time. Celsius made some unique distribution deals over the past few years which could be responsible for the recently improving cash conversion cycle. Now, let's look at Celsius's debt. The net debt to EBITDA has fallen over the past 5 years, going from 0 in 2018 to -4.2 most recently. Given that Celsius is profitable, the negative net debt to EBITDA value means that Celsius has more cash than debt. This is a very ideal situation for the company. The fundamentals of Celsius are pretty good. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Celsius. It is a beverage company with a gross margin of 48%. The 5-year revenue per share CAGR is 75%, and the 5-year free cash flow per share CAGR is around 181%. This is rapid revenue and free cash flow growth coupled with a good gross margin. A return on invested capital of 25% is good, but their value has been volatile over the past few years. Next, the cash conversion cycle of 129 days is a lot, but it may be affected by the distribution deals I will discuss soon. Concerning debt, a net debt to EBITDA of -4.2 means that Celsius is profitable and has more cash than debt. So, despite the massive shareholder dilution, Celsius is pretty solid. Now let's switch our attention over to valuation. Celsius is overvalued relative to the S&P 500 with a ratio of 3.9. The price to earnings growth, or PEG ratio, is not given, presumably because not enough analysts are covering Celsius. Celsius is a strong growth company with a rapid gain of market share. Management of this company has truly done a great job. While it is true that it is easier for smaller companies to grow, Celsius has grown profitably. Management has also done a great job of leveraging periods of multiple expansion to efficiently fund further growth with equity fundraisers. One interesting deal that comes to mind is the investment and long-term distribution deal Celsius did with Pepsi in 2022. In that deal, Pepsi bought an 8.5% ownership stake in Celsius for $550 million in convertible preferred stock. This preferred stock yields 5% annually and can be converted to common stock if and when Pepsi wishes to cash out. Pepsi also becomes the distribution partner for Celsius, immensely widening the distribution channel for Celsius. This deal is great for Pepsi and gives them much needed exposure to the growing energy drink industry. In the meantime, they collect the 5% dividend and gather strong sales data through their distribution of Celsius products. I would not be surprised if Pepsi acquires Celsius in the future. Getting back to Celsius, these recent financing deals decrease the immediate need for more equity raises and allow management to focus on further optimizing internal operations. As a company, Celsius is very strong and has a great future ahead. As an investor, I find Celsius a complex company to invest in. I would like to see more consistent free cash flow growth, more reassurance that equity raises are largely behind us, and a longer track record of improving return on invested capital and cash conversion cycle. Valuation is also extremely high due to the rapid growth and has been for some time. While an investor with a bit more risk tolerance might find Celsius a better investment, for me, I will wait for more consistency in the fundamentals and a better valuation. Many thanks for watching. What do you think about Celsius and their expanding market share? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.